Stephanie, I love this first line in your notes. There's more to life than the Mag 7.
Oh, you stole it from me.
Sometimes I credited you. Sometimes it just doesn't feel like it, does it?
No, I mean, if you look at the top 50 stocks by performance returns year to date, only one of them is in the Mag 7, and it's Meta, where you just talked about. I think the reason why Meta has been rallying so much is because, two words, one phrase, DeepSeek. I think, they're a consumer of AI, and they're going to be a lot cheaper. I'm excited, though. I think there are a lot of names that are doing well, and all of it comes down to the fact that there's more of a focus on what the companies are actually doing, in my opinion. Like who the company management is, what they're making, what they're doing, and what their valuations are because of the current levels of interest rates.
How are you thinking about these names in the here and now? I've heard from most. Now Amazon tonight, and then I said we got to wait a little bit for NVIDIA, which is, arguably the most important one of all, because of, as Stephanie said, DeepSeek and the developments that have been around that name.
My mind's changing a little. I mean, I've been a bit of a broken record for 3 years. I hear just saying you got to be at least market weight. Don't let them hurt you. You don't really know anything anyone else doesn't. I was just listening to that conversation. I looked up, there's 79 buys and 4 holds on Amazon, and the 4 holds aren't from any of the biggest 20 firms. Like it's hard to have a differentiated bullish view, and that's been why I wanted to at least be market weight and just don't let it hurt me. But I'm evolving a little bit more to the negative a little bit. And the reason is just, and timing, it's tough. But my view is that the beta of these stocks is really high, meaning you saw on that DeepSeek Monday, these stocks sell off a lot and disproportionately. And so, you could say, it's nothing, it's positioning, or you could say, you know what? I got incredibly high CapEx. The biggest 7 companies are spending more CapEx than the biggest 7, like almost since 25 years. I've got valuations that are reasonable to high. I've got some potential disruption for some of them. And so the portfolio impact on a down day looks a little bit riskier. So I'm not saying, this is terrible. I'm just saying if you were market weight, you ended up owning more than that with the bounce, with the beta. Maybe I take it down a little so that it's a little bit risk managed. I can find mid-cap stuff or other stuff to participate. So I'm kind of for the first time in 3 years just thinking I've got to be a little bit more careful just given this kind of CapEx and given, the potential that AI has to disrupt parts of the business.
Do you feel like, at some point, the risk level goes way up as a result of what these companies are spending? Are you in your own mind starting to think more clearly and maybe more skeptically about the return on that money?
I am, and I think the market is too, right? I mean, you made a comment I think was right. Meta's gotten our CapEx, you're innocent until proven guilty, and Google, it's you're guilty until proven innocent. Like the market's already trying to say these numbers are big, and ultimately that concentration of CapEx is probably going to end up disappointing, at least in pockets. So for now, we'll see. But I just think the risk is growing. I'm not saying, these are like terrible or whatever. I just think that if we're saying, hey, we're going to have this conversation once a year for the next 50 years, maybe there's only 5 out of the 50 that look a little bit riskier than right now, just in terms of the beta, the potential disruption from AI and business models, the valuation, the CapEx number. Like that cocktail has me a shade more cautious than any time in the last 2 or 3 years.
What do you make of that?
I think it's right. I have a target of 6,500 on the S&P. It's on the lower end of all the analysts out there, but I wrote in my note to you, actually, I'm thinking about lowering it simply because the Mag 7 make up about 35% of the S&P. I don't know if they're going to have these huge moves this year because there is a lot of digestion and figuring out what the return on invested capital will be for all the money they're spending. So they are large and there is power in that, but I think there's just a lot of opportunity elsewhere, which means it might be hard for the S&P to rally a lot, but there is still a lot of good investments to make.
How are you thinking about, Stephanie, expected policy that's going to be beneficial for the stock market? Just that baseline assumption alone is in large part, why this bull market is where it is and why it was able to sort of take that next leg after the re-election of President Trump. Despite tariffs, despite a lot of noise, there is the belief that once you get past all of that the trend is still up because you're going to get, in one form or another, you're going to get tax cuts and you're going to get deregulation and you're going to get animal spirits in some form.
I think there's an underlyingly good economy, and I think that's actually what forms the basis of this. But the tariffs were a surprise in the short term. I don't think they're over.
Were they a surprise?
Well, because I think the market was thinking, like, this isn't really going to happen. It's just a negotiation tactic. But then he did put them in place. And there is some stuff starting to happen. I think they haven't even come to Europe yet. And that is probably going to come too. So I guess I believe that there is a lot of good investments to make besides the big ones that will get pushed around by this market.
Like what? Give me, what's your best idea? Or one of them right now?
A couple of names that I like. One is Maple Bear, which is ticker CART. They actually I think they're moving into the S&P mid-cap now. They have a couple of really good partnerships with Uber. I think they just announced one with Ulta. I just think they're growing and doing the right things. They actually do have a lot of business in Canada, but I don't know if that actually impacts from a tariff perspective.
Yeah, what about you?
I think if people do trim these Mag 7, they have to fill that market cap with something else. I think you're going to fill it with other large caps and some mid caps. I like healthcare a lot. It's definitely contrarian. But there's things like GE Healthcare where there's some new products that could have upside to earnings. There's things where productivity can be enhanced. So if you want to, zig where they're zagging, I think you're going to see earnings be better than people think. Your policy comment on it really resonates because what I've concluded is the market's saying tariffs aren't going to really impact earnings for most of the market, but everything's going to hit healthcare. All of RFK's policies are going to hit healthcare. And I think the truth is in between, and I've got a sector that's really underperformed, but has some productivity potential and some earnings achievability that's above average. So I like healthcare. And then we upgraded industrials at the beginning of this year. I feel like we've got some data this week that things are maybe bottoming a little bit on activity. We have very easy comps in the second half this year for the earnings growth. So if the equity market anticipates earnings acceleration by 3-6 months, I think you can add to some of these industrial, which would maybe have decent risk reward in the second half of the year. So healthcare and industrials are areas I'm focusing on a little bit more here in Q1.